Everybody, welcome to our special webinar about an exciting new product that we're really amped up about. I'm Steve Olson, Director of Real Estate for the Peak Group, and I'm Ryan Bowers, our CEO. How are you today, sir?
I'm doing great. How are you today?
Doing awesome. Doing
Mhm.
awesome. Thanks
Mhm.
for taking a minute, and for all of you who have tuned in to listen to this, and all who will listen to it recorded in the future. We're glad to have you. We're Like I said, we're very excited about this because we have been resident real estate people for a long time, single family homes, quadplexes, development of apartments, and everything in between. And we think that this is a product for those that want a little bit more exposure to residential that come with a lot of its benefits as well. So you can see kind of some of the renderings here, and we're going to into what this means. And Ryan, correct me if I'm wrong here, but I think a big reason people should be excited about this is when we talk about flex space, that is, and what it does. Investors usually can only invest in this kind of if they are A, the developer themselves, or B, if they're a limited partner in some kind of syndication that buys a park of these things, 50 of them or something. And
That's
this
right.
is a very rare opportunity for them to own them condoized. You can see on the picture garages and doors. You could own one, two, or three of those. So you have flexibility to buy it and sell it when you want, but still participate in the asset class. How's that for a summary? Are we done now, or should we keep going?
We'll keep going, but that was a great summary. I think you and I have always been on the same page why we love residential so much because of the control in ownership that we can have on ourselves, not to have to just be an LP in a larger thing that we don't control. And so this model allows us to diversify kind of one step away from that residential model into the commercial side with a tremendous amount of options, flexibility to be able to diversify our own portfolio and our portfolio of our investors.
Perfect. And you can see on our agenda over on the left, just kind of a high level of where this conversation is going to go from an intro, why we like it. We'll expound on what we've talked about. We're going to get into triple net leases, compare it to single family and other residential investments. We're going to talk about what the demand looks like there, tenants. We're going to show you some of our renderings. You see Peak there, not capitalized. That's kind of our branding. It's not that we're bad at grammar, although we may be sometimes. But we'll keep rolling here. And so, Ryan, lead us into this.
Yeah.
We see the pictures, but what is this really?
Yeah.
What is flex space?
So we think of flex space, in the past, you may have looked at commercial things and they're larger buildings that are flexible. You've got some warehouse in the back, some roll-up doors, and some office in the front. And so this concept is a small flex space to where, we'll go as small as 1,300 square feet. And then you can start putting obviously units together. If you need larger, you could go up to say an 8,000 square foot building and take the whole thing as a build out if you needed to from a tenant perspective. But it allows so much flexibility in where small business is really heading today. And so if you think about so much of in the past, and we'll get into the types of tenants that we've had in the past, say, an HVAC tech or a roofer or, so many of these type of things that need a little warehouse space, a little bit of office space, but there's just not been a lot of options for this from smaller units and then be able to put those together and expand. And so that's really what we're doing here. Not that we're the only ones doing it, but there's a huge need for this because it hasn't been developed really at any kind of scale. Most industrial and flex you see are much larger buildings, 15,000 square feet and above. And so as you get into the need for all of the last mile, all of the gig workers, all of the small businesses that you think about the service industry, we are getting more and more used to wanting services, right? We want our food delivered to us and we want everything, our lawn done, our lawn sprayed, all the stuff that gets done on our homes. These are businesses that want to be close by to where they're working. And so a lot of flexibility here, a lot of benefits as an investor we'll talk about triple net leases. We'll talk about, not a lot of turnover cost. And so we just think that it's just a great addition to what we already focus on.
Very good. Thank you. So you got into some of it already,
Yep.
but let's talk about you kind of led into turnover cost and fitting businesses. And in residential, we can get tenants for a long time, but when you do turn them over, that dang carpet, right, we've got to repaint a lot of times. And in newer units, that's not as bad, and you can certainly value engineer and pick finishes to mitigate that. But it looks like if that's a hot button for you as an investor, you might like flex space just due to how simple the units are on the interior. Can you talk about that for a minute?
Yeah. Yeah, the interiors, and we'll see some pictures as we go here, are very simple inside. If you're going to take one unit, whether that's a 1,300 square foot unit or a 2,000 square foot unit, you're going to have small office space. You're going to have a bathroom and a little kitchenette, and these buildings are metal. And so, there's not a lot to damage on these things. Obviously, you get a family that's living in a house, wear and tear just happens. Even when they're a great resident in our house, there's still some more wear and tear that goes on with just living in that compared to, most businesses that are going to be in these. There's just not a lot of wear and tear that goes on. And when we do make those turns, even on tenant improvements, you'll often hear is TIs are oftentimes covered by those tenants. If they want more of a build out, say more of it turned into office, they're going to cover those expenses, which we never have TI. Unfortunately, on a residential home, we can't get the tenants to pay for our upgrades. And so those are some of the benefits that we have there. Obviously, high demand. We're looking at putting in these where there's a lot of growth. A lot of, like here in Dallas Fort Worth, where we're going to be putting a couple of these sites in, tremendous amount of growth in the submarkets of Dallas Fort Worth, to where there's not a ton of options already. You don't have office buildings and warehouses all over the place, and you have a lot of small businesses that want to be close to home and where they're doing business.
Right. And you're talking here on the deck about the above average returns right now. But what I do really like about it, I mean, it's inherent in the name, is it's flexible.
Yep.
You can pivot. There's a lot you can do with that space inside to kind of adapt with where the economy is going.
That's right.
Yeah. And yeah, we're absolutely not knocking residential. It's our bread and butter. It's you just think of it as a stock portfolio. You're not going to own just one kind.
That's right.
This is a way to kind of hedge risk and have some different attributes in your real estate portfolio.
Yep.
So if you're exclusively a residential investor, you think about this in terms of, okay, what's the market rent for a 3-bedroom home or a 2-bedroom apartment? Does the community have any amenities that I can charge extra rent for? Are there other things, rubs for utilities on an apartment building? This is different. So tell us about a triple net lease.
Yeah.
I think a lot of people understand it a little bit, but I think it is worth explaining further.
Yep. So if we think about the 3 ends in our triple nets, and we're looking at our property taxes, our insurance, and our general maintenance and property management fees are all included in this triple net, which then gets broken down to a square footage amount for the whole complex. So if you own a 1,300 square foot unit, you're going to pay, or the tenant's going to pay the pro rata share of that 1,300 square foot. If I own 6,000 square feet, my tenants are going to pay that as well. And so as long as those are occupied, all of those fees wrapped up into that triple net get billed back to your tenant on top of their base rent. And so in a single family home, we just say, hey, this is $1,800 a month. And out of the $1,800, we go and we pay the property taxes and the insurance and the maintenance and the property management fees, everything out of that. In a triple net lease, there's a base lease let's call it $13 a square foot per year. And then the triple net will be on top of that, which will get billed back to those tenants. And so in Texas, Steve, as you know, we get a lot of people that do not love our property tax rates on single
Myself
family.
included.
It's not any better on commercial, but this allows for more consistency and stability for our investors to be able to factor in what their net is. And so when we look at, say, a 6.5% cap rate on these, that's a pretty solid number because of these triple nets being billed back on top of that to the tenants. And so it's much easier to calculate, a little bit more stability from that perspective. Now, you can have some other advantages on single family where we're locking in for 3-year leases, which is a benefit in a lot of ways. But you're also locking in, you're getting rate increases. But if the market's jumping like it was over the last 5 years on rent, you're going to leave a little money on the table. If it's more of a normal process, of 2 to 3% a year, kind of like we're probably in right now, then we win on that side. And so again, not right or wrong between a commercial triple net and a gross lease on a single family, just different.
Yeah. It seems to me, because I've observed and certainly paid out of my pocket over the last 2 years, especially in Texas, these rapid increases in the cost of insurance, these rapid increases in taxes.
Yep.
And so a triple net lease eliminate that exposure. That's exposure we have as real estate investors, no matter what. But it seems like it's a good way to just kind of moderate it over time instead of experience it in shocks. What do you think about that?
Absolutely.
Okay.
Absolutely. And some will argue like, you can only charge so much in rent, right? And so at the end of the day, aren't I paying for it? Because, if my taxes and insurance go up a whole bunch, I really can't continue to raise my base rent, all that much. And there's certainly a case for that, no question. But at the same time, all things being equal, if you don't like the volatility of getting hit with those things and having that more stable income that will continue to go up, the triple net is a great option.
Yeah, good point. Okay, great. So let's finish it because we've already been kind of dancing around this. And but when we say single family rentals, I think we're going to throw in there to some degree fourplexes, duplexes. We love to do those. I've done a bunch of those. So let's talk here. Why don't what about the pros of flex space?
Yeah, and like I said, we've talked about this a lot, but I think the triple net does bring less operational burden on you. There's not going to be the amount of maintenance calls and decisions that you have to make on taxes and insurance because it's covered within that HOA, the condo association that's associated with the complex. So from an operational standpoint, I think it's certainly easier. You're going to have longer lease terms. Again, there's pluses to that for some stability, and there can also be, like I said, over the last 5 years, I'd much rather have annual leases on my single family because they went up so much, and so that can go either way on that, right?
Right.
We love the yields on these type of returns. And we do think that this is a great time over these next 5 to 7 years to be in this space because the institutions have not gotten into this. So our yields are much better now. And we think that the valuation for appreciation is really going to jump over the next 5 to 7 years down the road because the big boys always find a way to come in. If you've paid attention to single family homes over the last 5 years, what's happened, right? Institutions came in, drove the price up on investment properties. So we view this the same way. We talked about flexibility and then the huge growth for small businesses continue to be big.
I remember when the institutions started talking about coming into the single family market, and I thought, they're never going to be able to do it. In fact, it was that famous quote floating around from Warren Buffett that, was it 2012 or 13? He said, if I could buy a couple 100,000 single family homes, I would, but there's no way to manage them. Well, they're kind of doing that now. They're managing.
They figured it out.
They did, and they're always looking for more assets. So it'll be good to get ahead of the curve. I think along. I just wanted to expand on what you said. You know, the minimal management required. I recently had a tenant move out of one of my fourplexes in Houston, and in short, good riddance, because she decided she didn't like the neighbors and went complaining to everybody she could complain to, even reported me. I've got a property manager, to the Better Business Bureau. Um, and this was because she didn't like her neighbors. They were too noisy. I had to jump in and refute all this. And it reminds me of a quote I heard recently that I'll edit, which is, the effort required to refute BS is an order of magnitude greater than the effort required to create it.
Very true.
And so I got stuck trying to refute all this nonsense. And you know, when we deal with a commercial tenant, it's a pretty low trauma, cut and dried deal.
Yep.
They're in there, they've got their HVAC equipment, they're there for 8 or 9 hours a day. And you know, it's I don't want to say it's noisy, but it's a busy business center.
Yep.
And the complaints are minimal. So you are going to have lower drama. You don't experience those rapid rent increases like you could annually on single family, but you don't have those dips and all that nonsense that comes with it sometimes.
That's right.
Okay.
That's right.
Hey, let's swing over to the far right of the page, because we do like our residentials. Talk a little bit about the pros on the residential side.
Yeah, we love our residentials and always will. The stable demand, right? We focus in areas where there's always going to be a demand, where we don't maybe want to be the very top of the range on rent, so people can come down when we have economic issues, and when things are really strong, they can move up into our properties. And so the demand is not going to change, and we believe is going to continue to get stronger and stronger for residential housing as time goes on. There's a ton of options for financing in this space. You know, commercial is a little different. We do have options that we will have on the table, and we do have on the table, but there is still a lot more options in the residential space that we can fit with our investors' needs and what they're trying to do there. When we talk about lower tenant risk, it's just because there's so much demand for this from financial volatility. If we have huge recession, that can hurt small businesses in different ways. And so that can have a different effect on the commercial side. On the residential side, obviously the recession takes some of our residents out of our properties, but brings other demands in as well. And then the appreciation potential. The great thing about residential, unless you get up into the apartments, but everything else allows us the ability really with either selling to an investor, if that makes the most sense, or also an owner occupied, if that makes the most sense. And we can sell owner occupieds even on a fourplex, right, Steve? They can get a loan on that and rent out the rest. And so it gives us some options to look at how do I take the appreciation the best way? And that could be either an owner occ or an investor.
Gotcha. Yeah. I mean, when it gets down to it, financing is a tool, right? We look at it dispassionately. It is numbers. And, you know, some tools have things you really like about them. And on that 30-year fixed rate mortgage for residential, it's fantastic. And I think that the tool for commercial financing, you know, we're dealing with debt coverage ratios and a few things like that. You just have to understand what you're signing up for. And there's a little more math on the front end to understand it and to plan for it. If you do those things, then you can handle the tool responsibly. But we've seen some people, you know, lever up really high with commercial loans over the last couple of years with adjustable rates, and that tool can become a weapon directed right back at you if you don't plan for it correctly on the front end.
That's right. That's right.
There's some common ground here, right? Both of these offer that steady cash flow, and I think that's ultimately what a real estate investor is after. They want to take their hard-earned capital and have it do something for them more than they can do themselves. Tax benefits, right? We get depreciation on both of these. I think probably that leans a little bit SFR, right? You can depreciate over 27.5 versus, is it 38 on commercial? It's something in the high 30s. So, you know, your depreciation doesn't come as hard and fast, although on a cost segregation study, that could change a little bit. And your leverage, you can use leverage on both of them, and they're both certainly an excellent inflation hedge.
Yeah.
Any comments on the mutual pros before we go on?
I don't. Nope.
Okay. All right. So let's get into the demand. You know, our target here are small businesses. You know, Apple Computers isn't going to rent your flex space from you, but Bob's Plumbing or Susie's Gymnastics Club,
Yep.
right? These are your tenants. So enlighten us a little bit on this demand factor.
You know, what I love about this chart is if you just, you go back to 2015 on the left and you see 2.8 million businesses were created then, and then you pop up to 23 and we created 5.5 million. And so I don't look so much at the percentage of growth year over year. I look at the fact that my goodness, over, that 8-year span, look at how many more businesses came to the table. And that is just going to continue to grow as time goes on. And we know that right now over 32 million of the businesses have between 0 and 20 employees. And so, you think about, that HVAC company that needs the place to store and have some office. Well, most all their employees are out in the field, right? It's not that we're putting 15 or 20 employees in the building. That's the type of kind of command center that they're looking for to be able to do this. We think about, obviously, we run property management and maintenance, and we're always needing more space. And our office here in DFW and where Steve sits in Salt Lake City, we're sitting in office buildings and we have to go rent storage buildings to put all of our stuff in, right? So
yeah, right.
This graphs just kind of tell me the story about this demand that not only continues to grow, but is the place we want to be to offer this flex space for this group of businesses.
Right. Absolutely. Tonight I've got to go pick up my kid from club basketball, and these units are a little bigger than what we're doing, but yeah, you go in and this is a condoized flex space park, and they've got 2 or 3 offices in the front with a little reception area, a little gym on the top floor above the offices, and in the whole back out the garage, the bay door is basketball.
Yep.
And it's packed to the gills.
Yep.
Every day. And in that same space, there's a gymnastics club. There is an HVAC company. Even the city library moved into one of the units and is using that. So I've been a big fan of DFW and its growth. If you've been there recently, it is just endless. And within the next, I believe it was 7 years, it's projected and agreed upon by almost everybody that matters that it will pass Chicago as the 3rd largest metro in the US. So you take that into account with the need for flex space, and we're feeling really good about it.
Yep.
Okay, we talked a little bit about potential tenants. I've said some of that. Can you expand on that a little?
Yeah, I think we've kind of continued to hit on it. We'll just see the pictures as we go through here, but there's so many things. These are not going to be, when we talk about aftermarket automotive, these are not automotive shops, right? We aren't putting cars up on lifts and oil shops. That's not what we're talking about. And so we want to keep these really clean, really nice. This picture here of this gym, this is actually, Steve talked about where he's taking his son. This is actually here in DFW, where I had one of my boys trained for some time. And this would be like an 8,000 square foot building where they took the whole thing and dropped this 1.5 courts in there. And it's a spectacular facility, but would be very similar to, what we have. You'll see CrossFits in these, like gymnastics, like Steve said, they're really endless. So, there's so many great opportunities for small businesses, and they need these around areas, right? You think about whether it's, your business, whether you're training people, sports, whether you're HVAC, architect. I was just at a site the other day, and a whole engineering firm was moving into 3 units because they needed some storage space, and they loved the build out for their office.
Yeah, I was down working on a few things with you a few weeks ago, and we went through one of these that was recently built in where was that? Was that in North Richland Hills? I can't remember.
It was in Alliance, yeah.
Yeah, and it was packed to the gills with everything that you just said. Yeah. It was pretty impressive to see. So we've had the architects come up with a couple of renderings so we can show you what we've got planned for this project coming up in Weatherford, Texas, which is 20 to 25 minutes northwest of downtown Fort Worth. So you can kind of see here little office door and then a garage bay door for some parking, and they can do what they want on the inside. It's just that, it's flex space.
That's
So,
right. That's right.
So who are these people? Who is this a good candidate for as an investment, but wants to own this and rent it to Bob's HVAC company?
Obviously, what we're gunning towards is to bring this to our investor network, right? The same people that are buying, a quad from us or a house or an apartment are the same investors that we believe this is a great diversification for them to also be able to own these as well. And so that's our primary pick. Obviously, the business owners in these units can own them, right? And so that kind of, as we talked about before with residential, you could sell to an owner-occ or to another investor. The same option is true here. Is it more value maybe down the road and selling to the person that is running the business in your unit? Maybe they'll pay more than say what an investor looks at as just the numbers. And so those are kind of, your business owner is your owner-occ in the commercial side.
Gotcha. Great. So what does the development process, the onboarding process look like here?
Yeah. So, our experience in the past, we've been focused on where are things going. And so we jumped into the build to rent several years ago, and we supply brand new homes on the residential side. And so now from land and acquisitions and horizontal developments, that's what we've been doing for years. The vertical development of this, fortunately, is much simpler than building a single family home. And so, this is in our wheelhouse of what we already have been doing. And so we're excited about, obviously, the fact that we already have property management and leasing and maintenance. So we can just kind of roll this right in and keep going and be able to offer the service of both flex and residential within the same kind of structure of turnkey investments for our investors, so that they're not having to go to two totally different sources.
Gotcha. Thank you. And what I really like about this too, having been a part of a lot of large residential developments, and a good GC handles that no problem. But on flex space, 7 total trades to build a flex space building, correct?
Yeah, it's amazing. We go between 27 and 32, depending on what type of residential property it is. And we're roughly about 7 trades in a flex space. So yeah, it's, from a management standpoint, it's a welcome sight for us.
So from when an investor closes on their construction financing, which we've got set up, and many of you who have worked with me in the past have some experience there, it won't be a lot different, because a construction loan on, for example, a fourplex, as far as a bank is concerned, is a commercial loan. It's just a short-term, interest-only construction line of credit. That's what it'll be here. But as you've talked to the construction team, from when somebody closes and is ready to fund construction, how long before a flex unit is finished?
Once we're done with all the horizontals and we're ready to go vertical, we're in about 3 months and we're done.
Jeez.
And the nice thing about flex too is we're marketing that thing day one. It's hard to market a residential property before they can walk into it, see it, touch it, feel it. But businesses know, hey, if I'm out 3-4 months, that's great, because I need to move, I need to get out of my current lease, or whatever it is they're doing. And so the goal is that we've got a lot of these pre-leased before we're even done in the way we go. The first several will be brought to market, Steve, kind of on a finished basis to make sure that we're not putting that risk on the investors. And then as we have more ability to bring them in on the construction side, we'll do that as we go. But the pipeline right now is we'll bring these finished and they'll close on them with a lease in place.
Fantastic. Okay. So ahead of the curve, we talked about the institutions, but can you expand on why you think we're ahead of it here?
Yeah, and that's the big thing. If when we talk to a lot of the private equity firms in this space, when they think in a flex, it's much bigger. Everybody's 15,000 square feet and above, and so you kind of go all the way up to those, massive 1,000,000 square foot industrial buildings, and then you kind of come down into the 50 to 150,000 square feet, and then 15 to 50, and that's, as they come down, most of the smaller players are in that 15,000 square feet to 50,000 square feet. And so this realm is very mom and pop. Just like single family was forever, right? It was mom and pop, small landlords, acquiring up to large portfolios before the institutions got into it. And that's kind of where the flex space is. And so we think that there's great opportunity not only to serve a huge need for these small businesses that need it to get us a return, but to get in this well and ahead of the curve of when the institutions decide there's enough volume there for them to come in and start trying to take it out.
Gotcha. Well, that's fantastic. What I love about it as well is, no pun intended, the flexibility from an ownership standpoint, like we talked about at the beginning of the call. If you want to invest in this asset class right now, there is very little opportunity like this, or any organized opportunity for the Main Street investor. You've got to invest as a limited partner in a syndication. And those of you that have done that, it's great. I mean, I'm an investor as an LP in a few syndications, and it has its great moments. And there's some times where I don't love it. And many times that's not within the sponsor's control. It's a market situation. But you're not going to sell that when you want to sell it, right? You are at the mercy of the general partners and their business plan. And so that's a long time horizon with very little control. Conversely, if you say, well, I want to control it, you're going to be the developer. And you and I both know when you're the developer, control can be an illusion. You got cities and the economy and interest rates and a bunch of things at play here. So this is a great middle ground for you to participate in an otherwise inaccessible asset class, but with the flexibility that you have in single family residential where you own fee simple title. So we want to thank everybody for joining. Ryan, do you have anything else to say before we wrap it up and send everyone on their way?
I think we've hit it. I think it comes down to this isn't an either or. We just think it's a great addition to what they already have and what we already have.
Up to speed on the flex space projects. We've got a couple of them in the oven right now, and we're excited to talk with you about it. Thanks everybody.